All right, so what we're looking at here is problem 11-8, and what we're doing is calculating the book value and then the associated taxes on the sale of an asset at various prices. So there's four different sale prices here that we can look at. We'll look at the first one, 91,200, in depth, but the other three we'll just touch on briefly since the mechanics are mostly the same. But we have a new machine that was purchased 3 years ago for $76,000, and it's being depreciated under the typical 5-year table that we've been using for the class. And we have the need to calculate some various different gains as well as their associated taxes. So again, our sale price is $91,200. I'm going to flip the screen a little bit here. So what we have is, again, just to recap, purchase price of $76,200. We've got the asset was purchased 3 years ago. So we have accumulated depreciation in this case of $76,000 times the years worth of depreciation. So it was 20% in year 1, 32% in year 2, and 19% in year 3. So that's 71% total. 71% times 76,000 is 53,960. So that is our accumulated depreciation. And we use that to then in turn calculate our book value. So our book value is the, again, original purchase price, $76,000, minus the accumulated depreciation, and that gives us a book value of $22,040. So really the next step from here is to calculate our total gain. This is what we had done previously on most of our Chapter 11 problems, prior to being introduced to the concept of capital gain and depreciation recover or recapture. So the next or first step that you should really do is just calculate the total gain on the sale. So we do that by just taking the sale price, which was $91,200. That's what we sold the asset for after 3 years. We subtract the book value. This is the value that we show the asset on our books, which we calculated as $22,040. So the total gain on the sale is $69,160. That's our total gain on the sale. So in previous problems, we would have taken that problem there, we would have multiplied it times 40%. And if we do that, we get 69,160 times 0.4. And that gives us 27,664. So this is what we did in previous problems. We just calculated the tax on the gain from the sale of the asset. And then we were pretty much done at that point. Or we started looking at cash inflows or profits and cash flows in more complicated problems. But what this problem is asking you to do is take this total tax amount and break it up into the two pieces that are involved with the gain on the sale. So with a gain on any sale, we have two potential gains. We have a capital gain and we have depreciation recovery. Now this is the first time we're really running into a capital gain because most of the time we're selling the asset for less than what we bought it for. So there's a salvage value that's less than what we actually bought it for. In this case, we're actually selling the asset for a gain, and just like you would on your house. So think of it in terms of a home. If you bought the home for $76,000 and you sold it for $91,200, you have a gain of $15,200. Same thing applies here. We have a piece of machinery that we bought for $76,000. We sold it for $91,200, so we have a gain of $15,200 in this case. And we're going to pay a tax on that gain. And we calculate it very similarly in that we just take the gain, we multiply times our tax rate of 40%, and now we have a tax on that portion of the gain, which was the capital gain. So the second gain that we have is what's called depreciation recovery. And it sounds a lot more complicated than it is, but it's really just the other part of the gain. So if we were to just take the total gain that we've already calculated, the 69,160, and subtract the capital gain portion of 15,200, we'll see that checks out to be 53,960. So that 53,960 has to be the depreciation recovery amount. But the other way to think about it is the depreciation recovery amount is really just the purchase price of 76,000 minus the book value. And that's going to equal the same thing, 53,960. So again, we calculated the total gain at 69,160. Of that, the easiest part to look at is the capital gain because it's just the sales price minus the purchase price. And that gives us 15,200. So the difference between the 69,160 total gain and the capital gain of 15,200 has to be the depreciation recovery. But that's just kind of a double check way to correct or to check your figure. The other way, or the more the equation, if you will, is just simply the purchase price, in this case 76,000, minus the book value of 22,040. That in past problems is what we looked at as being the total gain, because in past problems our sale price wasn't more than the original purchase price of the asset that we were looking at. So with that 53,960, we're also going to pay tax on that. And in that case, it's going to be 53,960 times our 40% tax rate. And that gives us 21,584. So that's the portion of tax on the depreciation recovery part. And if we add them both together, so the tax on the capital gain plus the tax on the depreciation recovery, we get a total tax of 27,664, which is the same as what we calculated originally at the start of the problem. So again, there's several ways that you can kind of double check your figures, but the easiest way is just start with the total gain, and then from there you can calculate the tax rate on the total gain, in this case 27,664. But as this problem has you do, it breaks up both the gain and the taxes into their respective portions, which are capital gain and depreciation recovery. So that was just the first part of the problem for a sale price of 91,200. We're not going to go as detailed through the others, but if we look at the second one, 53,200, now we're back into kind of a territory of what we're used to seeing on these Chapter 11 problems, where the sale price, 53,200, is less than the original purchase price of 76,000. So in that case, when the sale price is less than the original purchase price, there's no capital gain, right? So capital gain is zero. If the capital gain is zero, that means the tax on capital gain is going to be zero, or it's not really applicable. That means that all of the gain, so if we look at the $76,000 minus the book value, all of the gain is going to be depreciation recovery. And in this case, our depreciation recovery would also, be taxed at the same 40% tax rate. So 40% of 31,160 is 12,464. So that's our tax on the recovery, which of course would be our total tax as well, because there's no capital gains tax to add to that. Okay, so just to clarify, so when we compare these first two problems, our gain, our total gain, was 91,200, the sale price, minus our book value of 22,040, and that gave us a total gain of 69,160. So the same thing applies for the rest of them. So in this case, on the second one, 53,200 is our gain. Is our sale price. And so if we subtract our book value, the 22,040 right here, that's what gives us our total gain of 31,160. So remember, total gain is broken down into two things. It's capital gain and depreciation recovery. In the second problem, there is no capital gain, so the depreciation recovery is the total gain. So 53,200 sale price minus the book value of 22,040 equals our total gain. And the total gain in this case is broken down into just depreciation recovery because there's no capital gain. Okay, so and then again, to calculate the taxes, we take 40% of that, our total gain, which is all depreciation recovery. 40% of that is 12,464, which also happens to be our total tax. Now in the third problem, This is the easiest one because our sale price, as you notice, $22,040 is exactly the same as our book value. So sale price $22,040, book value $22,040. So basically it's like a break-even scenario. So in this case there's zero gain, no gain at all. Sale price minus book value is zero. So capital gain zero. If there's no capital gain, there's no taxes, that's zero. There's no depreciation recovery. Everything is zero because there's no gain at all, and there's nothing to be taxed on if there's no gain. In the final one, we have a sale price of $15,400. Now, what's unique about this scenario is that this happens to be less than our book value, right? So $15,400 sale price minus $22,040 gives us actually a negative amount, which is $66.40. So in this case, we have essentially a loss of depreciation recovery that's a negative number, $6,640, of which 40% of that is going to give us a tax benefit. So 40% of that $6,640 is $2,656. So there's a tax benefit to the company. There's a tax benefit by selling the machine at a loss. So that's what's unique about the last one. Now, when it comes to entering these into the lab, you see obviously the parentheses, and you know that should mean a negative number. When you enter these into the lab, you can enter, in this case, just 6640. You can put negative 6640, or you can put parentheses 6640 in parentheses. Any of the three different ways that you enter any of these figures, it's going to give you, it's going to allow it or accept it as is. So probably the easiest way is just input the numbers. So if I was doing this problem for the first time, I would just, in this box here, just type 6640 with no negative, no parentheses, no nothing, just the 6640. The lab will put their parentheses in for you. And the same goes with these other two boxes here.